Hello, welcome back to Economics 360 International Trade. This is our 12th week, which means that we have only one more lecture next week. Today's lecture is essentially really one of the very simple ones in the book, because it only introduces some definitions and terms for two very popular formats that are used in measuring the performance of international trade for a particular economy. And so, in that regard, let me just stress from right now that we will not get the chance, obviously, to deal with the implications of the trade balances on the foreign exchange market. However, towards the end of our meeting today, I will make just a couple of remarks so that we wouldn't just keep it hanging in the air as such. And we will next time build and solve together a full model of a macroeconomy using, obviously, an open macroeconomy, that's to say, with the international trade sector in it. And that will be really the last thing that we're going to do. But in a sense, really, it's the highlight of the course. Outside of the trade theory per se, you're going to find out what are the implications of having trade theory on an economy. As it must be probably clear to most of you, because we've mentioned it before and the book makes a good attempt to explain it, there is absolutely no doubt that the performance of the domestic economy and that of the international sector are very, very interdependent. What happens in one will affect the other. We are no longer living in a world whereby one can afford to neglect the international sector, because the ramifications of what happens in one are extremely important in noting what will happen in the other. I don't want to make this very long today, but I cannot help but share with you at least what you probably already know, that the United States is looked upon, for example, as a country that is facing what is commonly known as twin deficits. Unfortunately, you find out that most people try to talk only about the domestic federal deficit. But really, the problem of the US is not only the federal deficit, which obviously has resulted in the accumulation of all that debt that's right now probably around 17 trillion, but really it is also in the fact that we have a very large trade deficit. And as you will find out in a moment only, there is no way that you can look at one without looking at the other. Actually, I hope that you still remember most of the basics, at least of your Keynesian model, which really is only what you have studied. I'm not suggesting that you must have studied more than at least the introductory macro. You would find out that the most popular definitions, and most of them, by the way, are when you talk about definitions, if you want to be very strict, a definition is really an identity, because you define something to be that way. It isn't that it is that way always, but you just define it to be that way, and so it really, in a sense, all of these things are identities. But be that as it may, The most popular are the ones that I wrote over here on the board behind me, so that you'll get a chance one more time to look at them and to understand precisely the depth of the relationship. I mean, there is no doubt in my mind that we can spend the next couple of hours or even more just discussing these issues. But obviously we have other fish to fry, so we won't do that. Except to remind you that what we're really saying is that the output of an economy, the GDP, is nothing else but a sum of these components: consumption, investment, government, plus exports. But actually, if you want to be very precise, you say exports minus imports. But I want to keep it this way initially, because this can be looked upon as being the aggregate demand, or the demand for the goods and services. And then we can look at this as being the aggregate supply, which is really the same Y, but it is consumption plus savings plus tax plus imports. The next step is very simple if you haven't done that before. If you go ahead and you set them equal to each other, what do you get? You find out that the C's drop out because they are really common to both sides. And so you're saying that I plus G plus X is equal to S plus T plus M. Now that is the condition really for equilibrium in any economy, and then in this case, an open economy with a government sector. So it's not Smithian. By the way, if you're going to be talking about a simple economy, as probably you might have done so in some of your introductory courses, maybe the introductory macro, you assume that the economy is closed, and at one time, to just start the discussion, you assume that there's no government. So if the economy is closed and there is no government, it becomes very simple. All what you're saying is that equilibrium implies that I is equal to S. Investment is equal to saving. We save so that the business community can invest, therefore saving is equal to investment, which determines the level of output of that particular economy. As you introduce government, things become a little bit more difficult, because then you're saying that I plus G must be equal to S plus T. It's no longer that saving must be equal to investment, but it is the sum of investment plus government, which is must be equal to savings plus taxes. Once you open the economy to have trade, it becomes even more complicated, because then it's the sum of these three that must be equal to the sum of these three. But since in this course we're really emphasizing trade, so let's put the X minus M on one side of the equality sign and everything else on the other side. And notice how important this relationship becomes. The X minus M is what's referred to in general as being what? The trade balance. So this is the difference between our exports and our imports of goods and services and income and whatever, as we'll find out later on once we talk a little bit more about the balance of payment. But the important thing is that this country exports this much, imports this much, therefore the difference between them, which is sometimes referred to as X sub N, let's assume that it is negative. Why it is negative? Well, because there's a trade deficit. Now, is it very highly unrealistic? And the answer is, of course not, especially when you talk about a country such as the United States. The US has been in a persistent trade deficit ever since 1976. Actually, the first trade deficit of only $1 billion, by the way, appeared in 1971. Then in 72 we bounced back into a small surplus, then we went back into a small deficit, then we went back into a small surplus, and then we went back into a deficit in 1976, and we've been there ever since. Now, how large it is for the United States right now is again another very important variable, at least to be aware of, to understand the implication of these. In the US right now, we've had a few years, I believe something like 2006, whereby our trade deficit was over $700 billion. So it was really close to $250 billion, which means that we imported more than we exported by $700 billion, which is something like $2 billion a day. Now, where is it that this money comes from in order to be able to pay these debts? Well, it's got to come, as you can see, from these. S plus T minus I minus G. Now, this can be regrouped a little bit so that it will make a little bit more sense, as you probably all know. So why don't I put the T minus G on one side, which is what, by the way? The taxes minus the government spending. So this gives me an idea about what? The deficit. So the government right now in the US has also been running a deficit for an extremely, extremely long time. So when this is negative, and let's assume, just for the sake of the argument, that the S and the I are more or less close to each other, but even if there is a deficit, that the deficit isn't going to be in the hundreds of billions of dollars because we only invest a few $100 billion a year. So really most of this deficit, therefore, is directly related to this, to the federal deficit. So what I'm saying, as you can see, in essence, is that it will be very difficult to have a large trade deficit without having a large budgetary deficit in the United States, for example, at the federal level. The same thing, obviously, is true of all other countries, but I mean, just to concentrate on the US. So as you can see, the performance of the local economy is very much influenced by the performance of the international economy. Now, again, in an attempt to just give you, or at least to refresh your memory concerning some of these small important details before we look at the balance of payment per se, let me remind you one more time what was one of the single most important critiques of mainstream classical trade theory. We did agree that most people who critiqued it critiqued at least by always mentioning the fact that the trade theory was based on a balanced trade. Which means what? A balanced trade means that your exports are equal to your imports. So notice in this case, if your exports are equal to your imports, and there is no federal deficit, then by definition also your savings are equal to your investment, and so everything is going to be hunky-dory, everything is going to be okay. Now, unfortunately, we find out that in the real world, this isn't always so, because many countries will have to import or sometimes export, such as China currently and Japan to a very large extent. They export more than they import, and so they enjoy a trade balance, or consequently certain other countries will have to bear the burden of a trade deficit. Now, if you have a trade, either a surplus or a deficit, what are the implications of this outside of the performance of the domestic economy? Well, it might be easier to think in terms of a deficit. If it's in terms of a deficit, it means that you have to find the money in order to be able to import these, to pay for these excessive imports. So you export things for only $1 billion, but you're going to import things for $2 billion, which means that you've got to find a way whereby you'll be able to come up with the money in order to pay for these imports. Now, trade theory suggests that really this shouldn't be a problem because the trade is supposed to be balanced. And this doesn't mean that you're not going to have any deficiencies. The important thing is that over a relatively short period of time, yes, so you will run a deficit one quarter, a surplus the next quarter, a deficit one year, a surplus the other year. But overall, let's assume over a period of 5 years or maybe even a decade, trade will be balanced. But when trade isn't balanced, then you have to find a way of raising these funds in order to pay for your imports, or do without. But we assume right now that you're really importing these things because they are obviously needed by that particular economy, and that becomes really a huge problem for very many of the developing countries. I mean, to just give you a very simple example, if one is going to look at Egypt, Egypt cannot feed its people without importing wheat. It is the largest importer of wheat of any country in the world. But Egypt doesn't really export that much in order to have sufficient funds to pay for the wheat and its other imports. And so it is bound to run into this problem that we're talking about. It will have to find ways of raising the funds so that it can pay for its imports. Which is, I'm using Egypt by the way, because it's a slightly different case. That's where most countries find themselves than the US. The US, there's something special about the fact that the dollar is the major international currency. So when we don't have the money, most people, most countries are willing to accept the dollars. And as a last resort, if we don't have the dollars, what can we do? We can go ahead and print it. As long as others are willing to accept the dollars, and that's why we have, by the way, such a large deficit. The fact that we import more than we export, we don't feel the pressure as much as certain other countries, because others are willing to hold our dollars, and it is easier for us to go ahead and print these dollars. But the Egyptians, to go back to Egypt, what are they going to do? So they go ahead and they print the Egyptian pound. How many companies in the world are willing to sell Egypt various goods and services, or wheat for that matter, by accepting Egyptian pounds? Most countries will say, no, I don't want to hold Egyptian pounds because it isn't hard currency. So they have a problem. What is their outlet? Their outlet really is very simple. Is to try and attract international funds into their country. And these days, as you probably expect, the easiest way is to go ahead and invest. So you attract certain other countries to come into Egypt to invest in Egypt by spending dollars or euros or yens or whatever the case might be. Then Egypt will take these funds and will be able to use them to go ahead and import the wheat that it needs. But how often is the world willing to go ahead and invest in Egypt, especially when its, let's assume, political situation is looked upon as being unstable, or when its neighborhood is also not very stable, where there's always the possibility of a war of one form or another? It becomes very difficult to be able to attract enough of these funds. And that's when such a country runs into what is known or referred to very often as the balance of payment problem. Because the other thing that it can do, but obviously we cannot get into all of these details right now, is that it is allowed to go ahead and borrow some funds from the IMF. But the funds that it can borrow are rather limited. But the IMF is probably the first place that they'd go to borrow some money when they can't raise it. Which leaves them, by the way, with only one other thing. And normally they would do that probably even before they go to the IMF, because the IMF will ask them to go ahead and do it anyway. And that is to sell their official reserves. So let's assume that the central bank is holding, say, 200 tons of gold. Then they'll ask them to go ahead and sell that 200 tons of gold in order to use it for such thing. So they do not have, my point is, these countries these days, especially because of globalization, we have become too much interdependent, or very much interdependent on each other. And so it's difficult to perceive of having a balanced trade as the trade theory expected 200 years ago. And so the issue has become much more complicated right now, and that is why we set up all sorts of different mechanisms to measure it, so that we'll be able to undertake appropriate steps that will go ahead and deal with that particular problem that we are facing. Obviously, the first thing that I want to mention, by the way, is the fact that there are really essentially two major measures. The balance of payment, and then the U.S. net international investment. The balance of payment is obviously the single most important thing when it comes to international trade. What it is really, one of the simplest definitions, obviously, is the fact that it really is nothing else but a record of all activities between the residents of one country and the residents of the rest of the world. Now, as simple as it is, a number of big issues arise. Now, for those of you who are interested in these big issues, and I hope many of you would be, you're not going to become an expert by spending a couple of hours or even a couple of afternoons. But I did include on Blackboard the manual of the IMF. The real reference of all of these terms that are used and the rationale behind them and why is it that they're structured the way that they are structured is the manual of the IMF on balance of payment. That manual, if any of you has looked at it, and I hope that you have because we did assign it, is around 158 pages. So definitely it's a very big book, and it's probably a little bit boring to read. But if you flip through the parts that you're interested in, you'll find out that it explains practically every single detail or every single imaginable problem that you can think of, or in order to understand what's meant by the balance of payment. But since the balance of payment is nothing else but a balance, but a record of all of these transactions, the first thing that really must be probably emphasized is that the balance of payment is a record that uses double entry bookkeeping. Whenever one uses double entry bookkeeping, it's like a checkbook. The accounts must always balance. So a balance of payment, because of double entry bookkeeping, is always in balance. What we mean when we spoke over here about problems that arise from unbalanced trade is that if you have a deficit in what is commonly referred to as the current account, and the current account is made up of goods and services, income and transfers. So overall, in the current account, you might have an excess of imports over exports, which means that you've got to find a way of paying for that particular deficit. So you do that by creating a capital inflow, a financial inflow into the country in the financial account. So technically, theoretically, the deficit in one account is going to be balanced by the inflow in the other account. And the reverse is true. If you have a surplus in one account, it will be balanced by an outflow, a financial outflow in the other account. So when you have a country such as the United States, whereby the current account, as we have already mentioned, has been constantly in deficit for almost 40 years. What does that imply? And these days, as I said, we're no longer talking about a few billion, we're talking about hundreds of billions every single year. So what that means is that the financial account will have to attract enough inflow of capital into the US in order to be able to compensate for this particular deficit. And as long as we are attracting enough of these funds, which obviously we are, otherwise we wouldn't be able to go on, then it really isn't, at least from one aspect, such a major problem. Then the balance of payment will be in balance. And that's why in the United States, since we've been able to attract enough funds, you don't find people really talking about a problem in the balance of payment. Our problem actually is the fact that we have the consistent deficit on part of the balance of payment, which is the current account. But notice my point over here. If this is a deficit, then you've got to be able to attract the funds. If this is a surplus, it'd be exactly the opposite. I mean, I wouldn't be surprised if we run into a large surplus for, let's assume, a very long period of time. Then that means that the United States will have to be sending funds overseas. There will be an outflow of financial funds. And then the same people who are right now complaining about the deficit over here will start complaining about the fact that we have an outflow. But this outflow, by definition, is supposed to occur whenever this is a surplus, and an inflow whenever this is a deficit. And that's why they are always in balance. To be totally fair, but obviously we're trying right now to deal with it rather quickly, there is a third account, which is the official reserves. The third account really is that what the country holds, the central bank usually, of hard currency. In the US, it will be yens and euros and sterling, Swiss francs, and what have you, in addition to our gold. The US does hold, by the way, as you can see from here, I mentioned it, we'll look at this in a minute, a little bit over 8,000 tons of gold. And this is consistent, because we don't feel the pressure to go ahead and sell our gold, and we don't bother to buy more gold. So this official reserve that is used also by very many other countries in order to compensate, or in order to make the balance in the balance of payment balance, the US doesn't use it very often. We use it every once in a while when it comes to the reserves, when the Treasury or the Fed decide to take certain action in favor of maintaining a particular foreign exchange rate for the dollar. So essentially, you're saying really that the balance of payment is a double entry bookkeeping. It always balances. And when we speak about double entry, it means everything creates a credit and a debit. The best way of understanding these, the credits and the debits, will be to look upon that particular act in terms of whether it creates a capital inflow to the United States or a capital outflow from the United States. Any activity that creates a capital inflow into the United States is a credit, such as exports. When you export goods and services, somebody has got to pay you. So you export cars, you're paid. You export wheat, you're paid. Therefore, these are classified as credits. The same thing is true, obviously, about services. Services didn't used to be very large, but they have grown substantially over the past few decades. And the US, surprisingly enough, or maybe not surprisingly enough, we've had a surplus in our balance of services. That's to say, we export more services than we import. So up until now, as you can see, in the US in particular, the services help to compensate for part of the deficit on the goods side. Obviously, when it comes to income, we find out that income that is generated by assets held by the United States overseas, and by Americans, by the way, who are also working overseas. And then there is also the counterflow, the money that is generated by assets owned in the United States by foreign nationals. So that will create an outflow. And the money that is earned in the United States and by foreign nationals who are working in the United States. So as you can see, the current account is the goods and the services, the income, and then there is one item that is a little bit more problematic than the first two, which is the transfer payment. In particular, these are unilateral transfers. Let's say in each of the other one, you export a car, you get paid. You import a machine, you have to pay. You own an asset overseas, you earn some dividend. Somebody owns an asset in the United States, we have to pay a dividend. But in the unilateral transfer, there is a reasonable sum of money that is paid from one country to another country without getting anything in return. The single most important thing that I hope it has immediately come to your mind will be grants. When the United States grants a particular country, say $5 billion, so that $5 billion is sent from the United States to the other country, and in particular, by the way, when we do that very often in military hardware or maybe even agricultural goods, then we're not going to be getting anything in return. The general idea behind this is that you're really buying maybe the political credit from that particular country. Otherwise, you wouldn't be helping it. But there is an item that has really grown a lot over the past, again, 2 to 3 decades, that is becoming even larger than that of grants, and that is what is known as the immigrant remittances. So nobody knows exactly what is the exact number of immigrants in the United States, because it depends whether you're going to consider immigrants from the U.S. based on only birth, or whether it's going to be the birth of parents, and when do they become American citizens. But the fact remains is that quite a lot of the Americans, and in particular those that are classified as immigrants, they come to the U.S. to earn money in order to support their families back in their home countries. And obviously, the first example that usually comes to mind will be the Mexican labor in the United States. Most of the Mexican labor in the United States works in the US in order to support some of their families back home. And that's why there's a rush to the Western Union at the end of the week or month or whatever it is, so that they really, literally speaking, sometimes send back home most of their money. Now that amounts again to a few $billions every year. Not only a few, actually, maybe even over $20 billion a year. So once you add all of these together, in a country such as that of the US, we still wind up with a deficit over the current account. The figures that come to mind right now, I believe, for 2013, and I remember it very clearly because the figure was almost even. It was almost 100 billion. There was a deficit of, actually, to be precise, I think 99 or 98 billion. Which means that the US right now wanted to, or had to, in order to balance the account, find a surplus, find a capital inflow that will match that 98 billion. And that came out of the financial sector. That's to say, very many of the capital inflows did not amount, by the way, if you remember, my memory serves me correctly, in the United States, to cover the whole 98. I believe that we wound up with something close to around 50, and the other 40 was accounted for through statistical discrepancies. Just like the GDP, there's always, a statistical discrepancy to try and bring things into balance. And normally, the smaller it is, the better it is, the more accurate the accounts are. So 40 billion for a country such as the United States, whereby you're really talking about a very, very huge figure, is rather acceptable. It would be better if it is smaller, but 40 billion isn't such a huge deal. The services is another sector that I figured that I will highlight a little bit, just because many people do not really seem to understand. It doesn't have to be an outright service that you sell overseas. It could be something such as, the best example would be, by the way, those of you who are students but are not US nationals. Let's assume that there is, a Korean, a Chinese, a Frenchman, or whatever that's registered in this course. Then your parents are, or guardians, or governments are paying your, say, $50,000 expenses every single year. Now that is equivalent to having the United States export an educational service. So that is looked upon, by the way, as being an export, but it's an export of a service. Let's assume also that your parent or your friends, if you are from overseas, they come to pay you a visit. When they come to pay you a visit, what do? Well, they're going to fly an airline. Let's assume that they have flown an American airline. Then that becomes also an export. If when you fly on JAL, for example, then that is counted as an import. So many of our daily transactions are really going to affect the balance of payment, but many of us are not totally aware very often that these acts that we do are going to reflect on either counting that particular activity as an export or as an import. I mean, if you are to be nationalistic, and I'm not suggesting that you should be, then when you want to travel, you will probably try to travel, if you're an American citizen, using an American airline. Because both of them are going to take you from here to, let's assume, London. But if you choose a European carrier, then it would be counted as if it's an import. While if you fly there on Delta, then it wouldn't be counted as an import. And so on and so forth. But to go back to the people who are visiting you, when they come to visit you and you go and they invite you, let's assume, to a restaurant, and they spend $500 for a dinner. That is, again, it's what money coming to the United States, because they brought their money with them to the US and they spent it at that particular restaurant. So that is counted as if the restaurant has really exported its meal to the other country. The same thing is obviously true, by the way, of very many of the medical services. When you have very many foreigners that come to the United States in order to have an operation, a medical operation done, that is also looked upon as if really it's a US export. But the most important services are really those of transport, of finance, of tourism, and of travel. And the unilateral transfers, as I said, are really gifts and remittances. Maybe what we should do right now is just look at a few figures so that to try and make this a little bit more concrete of the US. Now, this is the United States balance of payment. I double-checked these figures last night. They are as of the for September, sorry. These are for September 2014, only 1 month. So during September, the exports to the United States, of the United States, amounted to 195.6, the imports 238.6 billions. So really the deficit on our balance of trade was $43 billion. Now these are only goods and services. But once you account for all the other components of the current account, we found out that last month our current account in 1 month had a deficit of $98.5 billion. Our gold last month held steady. I don't think really it has changed in a very, very, very long time, at 8,133 tons. And our crude oil production, I figured I'd mention that again to show really the connection between these, the international accounts and the domestic economy, was 8.6 million barrels per day. Now, why am I mentioning this? If you still recall, what did I say was the first time, at least in the past 70 or 80 years, or maybe even 100 years, that we've had a trade deficit? It was 1971. Then I said in 72 we had a small surplus, 73 a small deficit, 74 a small surplus, and then in 76 we fell into a deficit that we never recovered from. What is it that happened in the 70s that affects the US? And why is it that our balance of trade is so much in deficit? What is it that we import so much of that is creating this huge deficit? As you might have already guessed, I hope by now, it is oil. the price of oil jumped from, it used to be, by the way, around $3 a barrel. Then it hit around $11 a barrel very early in the 70s. And by the 80s, it was over $40 a barrel. And then, at one time it was $150 a barrel. And right now it's back in the mid-70s. Some people expect it to go back to the 90s. Some people say that it might even drop a little bit more. Only time will tell. But my point is, what happened in the 70s, and it was really a double whammy in essence. The price of oil went up substantially, but the domestic production of oil in the United States started dropping. Now, very many Americans feel very good recently, not only because the price of oil has dropped, relatively speaking, but also because our oil production has increased, and rather substantially. At one time, I think the highest that we've ever produced was in 1970. So in 1970, probably we didn't import that much oil. We produced around 10 million barrels of oil a day. And that dropped, by the way, at one point to 4 million barrels a day. But to run the country, we needed at one point around 20 million barrels a day. So we used to have to import more than 10 to 15 million barrels a day. Right now we're importing only around 8 million barrels a day. And if this keeps on increasing, and some people think that we will hit 10 million barrels a day soon, then that will be an additional 1 million barrels less of oil imported every day. And that can be substantial, because let's assume, just for the sake of the argument, that the price of oil is 100, then every million barrels, that is $100 million every single day. So if you are importing, say for the sake of the argument, 10 million barrels at $100, then that's $1 billion a day, which is $360 billion a year, which is most of our deficit in goods and services, or actually in goods. In services we have a very slight, we do have a surplus, but it isn't big enough in order to compensate for the deficit in the goods. Having said this, there is another thing that I figured that we must really mention before we say just very, very few things about the foreign exchange. And that is one idea that you hear quite a lot about. We classify countries as being either creditors or debtors. A creditor country is a country that has, and these, by the way, are the net position. That's to say, if a country is going to go ahead and liquidate all its holdings in the rest of the world, and the rest of the world is going to liquidate all its holdings of that country, then what will be the net position? Currently, again, to look at the US, since it is, so far at least, it's still the largest economy, you will find out that we have a net of over $5 trillion. Because what we're saying is that our assets of the world, that's all what Americans own of the rest of the world, is valued at almost $25 trillion. But we're saying that the rest of the world owns of the United States around $30 trillion. And so if all of these things are going to be netted, we'll find out that the United States will owe the rest of the world $5 trillion, which means that we are a debtor nation. We are in debt to the rest of the world. And by the way, where does a debtor nation come from? As you can see, I hope, based on what we have discussed earlier, It results from the fact that you have a deficit on your current account. Because the inflow of capital from the rest of the world to pay for the deficit in the current account is going to be buying part of your country. So these $30 trillion are really the sum of monies that have come over the years to the United States to invest in America. So the ownership of American-based companies by foreign nationals amounts to $30 trillion, while our ownership of the rest of the world amounts to $25 trillion. So as you can see, we are right now a debtor nation. Actually, we have been a debtor nation ever since 1986. And it will be difficult to suggest that this will go away anytime soon. Because as you can see, we're talking about a relatively large sum of money, over $5 trillion, which is going to grow every single year. Because the only way that we're going to be able to finance the deficit on our current account will be for the rest of the world to increase its ownership of our assets, which will be looked upon as being a U.S. liability. So that is more likely to grow. Now, what's important, by the way, about this is that, remember, I said only in 1986. If you look historically at the U.S. was looked upon, at least for the past 100 years or so, as being the country that was really buying the rest of the world. Why? Because in particular, after World War II, but it can really go back to the late 1920s. From the 1920s to 1986, the United States was in a position whereby it was still investing overseas. But remember what I said, that our deficit started really emerging in the early 70s. But it took it a while, because we had accumulated so much ownership overseas. So by 86, it took it around 10 years exactly, because our consistent deficit arose in 76. We became a debtor country in 86. So we didn't become a debtor country immediately because we had accumulated so much ownership of the rest of the world, so that ownership, or that additional ownership, did not disappear for a period of 10 years. So the point is, these things are to be expected. When you're a country that is that is exporting more than you're importing, then you're going to be buying more of the rest of the world. So you'll be a creditor nation. When you are importing more than you're exporting, then you're going to be a debtor nation. That's to say, you're going to be selling parts of your holdings to the rest of the world. So the U.S. was initially built by being a debtor country. It was the Europeans who helped build the railroads and what have you in the United States, up until after World War I. And then we went through a period of around 50 years whereby we were the major creditor country in the world. And right now we're again a debtor country in the world. What is important is not only whether you're a debtor or a creditor, but the use of these funds. If you're going to borrow money in order to just consume and spend things frivolously, then you'll really be asking for trouble. While if you're going to borrow that money in order to renovate the infrastructure and invest in education and healthcare, then that's a completely different thing. And so personally, on a personal level, I don't have really any problem with the fact that it's a debtor country. Now, before we leave, as I said, I'm going to leave you with only two more small things, and that is to try and one more time at least highlight the importance really of foreign exchange. We're not going to be able to build any models right now, but the foreign exchange essentially really is nothing else but supply and demand. And so this is what we know, or what we have known right now for the past 40 years, the foreign exchange are really totally flexible. So the price of the dollar vis-a-vis the yen is changed with every single particular transaction. The price of the euro vis-a-vis the yen or the dollar are determined in every single transaction. But what is crucially important for the role of foreign exchange rates is the role of the arbitrageur. An arbitrageur is a person who does not take risk. He gets into a transaction whereby one is assured of a profit. So the arbitrageurs, they take advantage whenever there is a discrepancy in the rates anywhere in the world. They will jump in and buy and sell simultaneously, so there is no risk taking, and their actions bring back, they shut down that window. So they bring back the rates to a particular uniform level all over the world. That's why, for example, the price of oil is the same all over the world, the price of gold is the same all over the world, and the price of foreign exchange should be the same all over the world because of the acts of these arbitrageurs. Now, it's very simple. When you happen to have a commodity that is selling in one market at what price, at another market at a different price, so you buy in one market and you sell it in the other market until the prices become equal. But the difficulty, or the idea that I wanted to bring to your attention, is that which is known as a three-point arbitrage. A three-point arbitrage, I wanted to give you a very simple example over here. I hope you can see it. I said, let's assume that in one market, the sterling is selling for $1.60, the euro is selling for $1, and the euro is selling a cross rate in a third market at half a sterling. Immediately right now, you'll have a room for arbitrageurs to do what is known as a three-point arbitrage. Let me give you a very simple example that I worked out. So let's assume that you have 1,000 euros. What would you do with 1,000 euros? You'll go to this market and you'll exchange them into $1,000 because the rate is 1-to-1. Then you'll take your $1,000 and you will buy over here 625 sterlings in this market, because each sterling is $1.62, therefore each dollar is only 0.625 of a sterling, so $1,000 is 625 sterling. Then you come to the third market and your 625 sterling will buy you 1,250 euros. Remember, you're doing these three things simultaneously. So what happened? You start with 1,000 euro, you end up with 1,250 euro, so you made 250 euro. 25%. I mean, that's not a bad deal. I mean, in the real world, it's not going to be that big, but arbitrageurs are always going in and out of a particular market in order to maintain that particular price. Now, let me mention one more thing before I bid you farewell. And I didn't bother to write it on the board because really it's a little bit complicated, but I figured that I would be remiss if I don't at least mention it. Because you'll always find out that there is such a thing as a spot rate, that's to say what is the rate of exchange on the spot in the market, and there is such a thing as what they call a forward rate, that's to say for the future rate. Now, when people speak about the fact that the foreign exchange rate is very often affected almost immediately by what happened to the interest rate in one market, that becomes very clear from what is known as the interest rate parity of a covered call. I don't want to get into all the details because it will take probably an hour by itself, if not even more. But what that really essentially means is that if you have the spot rate for two currencies, and you know the interest rate in one country and you know the interest rate in the other country, then as the interest rates changes, that will change how much a person can earn on that particular country, or on that particular currency. And so an arbitrageur will always be buying and selling in order to equate the interest rate earnings on the same sum of money in both countries. And that therefore will require an adjustment in the forward rate. So the rates of exchange will adjust depending to the rates of interest in a particular country. And that's why whenever you hear the news, you'll find out that if a particular country wants to improve the exchange rate of its currency, they might go ahead and introduce a higher interest rate through the monetary authorities. And if that is deemed to be acceptable by the financial markets, then in almost no time you'll find out that the rate of exchange would improve or will solidify. Now, having said this, I'm going to have to bid you farewell, but as I said, keep in mind that next week we're going to try and work together one numerical example of a macro model of an open economy. Okay? With that, I'll see you next week. Bye-bye.